Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, on air live with Mr. Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content on the internet. The best place to do that is to follow me on Twitter at Focused Compound. That's where I put out all the content that we upload. I tweet a bunch of different investing things I find interesting, and just basically everything centered around focused compounding comes out through my Twitter at Focused Compound. You could get that handle in the description if you need it. If you want to learn more about our money management services, blog posts by Geoff, and then, of course, our podcast backlog. Well, you could go to a podcast app, or you could go to focuscompounding.com and get access to all that information. So there is no investor on the internet that has more content than we do, going all the way back to 2005 by Geoff, and you could get access to that just by going to www.focuscompounding.com and scrolling down to click December 2005. And you will get all his old write-ups for free at focusedcompounding.com. I did reference our money management services. If you want to learn more about that, click the Invest With Us tab at our website, and you'll get everything that you will need on that. But Geoff is still uploading blog posts, so you could get those free posts at our website. It's right on the homepage, www.focusedcompounding.com. Everything that we do is going to be in the description down below. So speaking of blog posts, Geoff, you had uploaded 3 new articles to the website. We can quickly go over them. Of course, people can view them themselves, like I said, by going to Focus Compounding. And you wrote about ALICO, which the title is ALICO, ticker ALCO, fails to report results on time, blames deferred tax liability accounting issue. So maybe take us through here. I mean, you wrote about, what is this, 5 paragraphs, very brief. But What is it? I mean, with these small companies, I mean, this company seemed to have had it together. Why did they fail to report on time? Is this something that's pretty severe? Is this something that would worry you? Is this an easy fix? What are your thoughts?
Well, we can see on OTC markets, maybe if they've updated it, they came out with a press release after this, a few days after.
So they read your post.
Setting a new date for their financial results release. But they did fail. This would have been the 10K to file on that day. And they basically said on the day that it was coming out, scheduled to come out, that so far we just have that they provide let's see. Oh no. Yeah, so yesterday they did do it. So it was a 1-week delay basically, right? So the thing that was interesting about it, of course, is that it came out I believe the day they were supposed to report and have a conference call and everything, saying that they were delaying it. So it wasn't like they announced ahead of time that they were going to delay it. Obviously, if a company just puts out a 10K normally without saying we're going to report our results on such and such a day, then they don't have to say we're delaying it, right? So like NACA would have to say we're delaying it because they do this thing where they say we're going to report on such and such a date, and there's a conference call and a press release and all that. But we invest in plenty of companies where they just drop a 10K or a 10Q. They might there might be a press release that's included as like an 8K, but they don't say ahead of time it's happening. It just happens, right?
Mm-hmm.
We're in some companies like that. Now, for really big companies, that almost never happens. So ALCO has increased their investor relations over time, and they do this. So because of that, and there's been a change in who kind of is running things at the company. I think I got into that in my blog post originally about it. But I also mentioned in that little blog post that they had a CFO leave earlier this year. So they have a new CFO too. So having a new CFO and dealing with issues like that, I mean, sometimes that does more likely that you would find issues that you think there's a problem with. The thing that they explained, and they explained how they would have to change it, is that if they said that if required would be a decrease in the deferred tax liability and an increase in retained earnings for the prior period or an out-of-period adjustment increasing net income for fiscal 2022. So what they mean is that they would have to, what they're basically saying in that sentence is that they may have overestimated their deferred tax liability and then thereby underestimated the retained earnings.
Which is great for investors.
It is, yeah. That would be a positive. So I think they didn't give that explanation when they first said that, they gave that explanation when they did a follow-up, I think the next day or something like that. So they just said that we're putting it off and everything, and then they gave this explanation of what would be the change, probably because of questions, right, from investors of what does this mean, that you might have to restate prior periods. And they said that they could go back to fiscal 2019. And so now they did report. So that was yesterday. And I figured that I would follow up with that and write another blog post after they actually reported, which is what I was waiting for. Originally, I was going to update it, but then I thought, my blog post would be really short, just saying, oh, they said they're going to do it this week. And I was worried about that because there's a couple other companies, Tandy was one, IEHC was one, where if I did that, I'd keep saying it because they kept saying, we think we're going to report, and then here's an update on it, here's another update, So this doesn't affect the SEC stuff because obviously you didn't have to file, and you have a pretty long grace period for filing for a 10K, and you can request a longer period.
Mm-hmm. Well, it's good that they got it done pretty quickly.
Yeah, so it's a pretty big item. Deferred tax liability overall for the company is a pretty big item. But it is interesting. They've had a lot of, land sales over time and all of that. So we'll see what happens exactly. But obviously they pointed out a pretty benign sort of thing there. But if they have problems, there have been companies that have restated things before that are generally a positive. Many years ago, Microsoft was forced to restate, but that was kind of connected to that. So with Microsoft, they had understated their retained earnings. But in that case, I think that also kind of gave insight into that they might have engaged in some smoothing of the earnings. And so that may have been why that was happening. It's always a bit of a concern. The company's fairly small in terms of the number of people in management and everything. And like I said, the CFO left. I gave the quote about the prior CFO. And I also talked about how the stock is now basically trading at about 50% of what they've said in the past. They estimate the value of the land is. So they give you that breakdown of the enterprise value and everything. And I think they estimate their land is worth, this includes both the citrus groves and the ranch land though, 500 million or something like that, in the category of 500 to 500. Well, let's see. They have the slide here.
Mm-hmm. So this was from which one? This is from June 13th presentation.
Yeah. And we just need the raw top number that it has. Yeah, there we go. So they estimate the implied enterprise value is what they're saying, which is what they mean would be the value of our land. 505 million to 628 million. The market cap now, what is it at? 200 million? And then there's 100 million of debt. So if you take up, right. So if you take the bottom end of their estimate, 505 million, subtract 100 million of debt, and then adjust for the fact that today the stock's down 10%, that's 400 million. And then you have half of that. Their debt's a little higher now, but basically they're saying that net of debt, their land is probably worth about 400 million. And then the market cap then would be about half of the value of the land. But of course, a huge portion of that, as you can see in the estimate, is the citrus land, right? Mm-hmm. The ranch land really only covers the debt. Mm-hmm. But I would point out that another way to think about the company is you're basically getting the citrus groves and the operating business on them for free. Not for free, but for no debt. That is that the price that you're paying is just buying that at book value, at fair market value, I should say. That the debt, yes, there is debt, but it's not something to worry about because it really is covered entirely by the ranch land. And they have, in fact, been selling off ranch land, paying down debt at times, and paying out dividends. And they have quite a high dividend, actually, that they paid at times. So I'll revisit it. So this is kind of just like between now and our next podcast, I'll have done another write-up of ALICO. I was waiting for them to come out with this update and see if that gives any more insight into it. But obviously, it raises some concerns about the accounting and all of that, especially if there's been a change between who's running the company over time, if there's been a change with CFOs and all of that. And I always worry about that with smaller and less well-known companies. This is not a tiny company. I think that the requirements of reporting to the SEC and the accounting and everything are important, and often value investors overlook that part, and it can be bad when you get into a situation where that's not handled real well.
Mm-hmm. I mean, do you think this is a situation where you go from, I don't want to say less of a professional CFO, but maybe they did a search and did hire a quote unquote professional CFO that maybe has more experience with this sort of stuff, and he's looking at the situation as, hey, actually you guys misaccounted for this. I mean, it's a weird timeline that, like you pointed out in your article, that, the old CFO quits, they bring in somebody new, and then, now they have this issue, if you want to call it an issue. I mean, I guess I would say it's a positive issue for shareholders, but it's still something, right?
Yeah, I think it's been more professionalized over time. It was more controlled by people who were sort of large owners. They owned it through investment vehicles and stuff. But yeah, I'd say it's moving more of a time towards more of an operator run company, rather than with professional management at the top, rather than a more closely controlled company.
Yeah, I mean, if you look at their investor relations campaign, and especially like their presentations, this is what you would want to see in a land bank. I mean, I wouldn't even put this in the same category as other entities we've seen that are quote unquote land banks, right? Like they actually generate cash and have an operating business on top of it. That is interesting. But I mean, read these slides right here if you're watching on YouTube. I mean, it has been returning substantial capital, approximately 174.2 million of capital return since 2014, including 29.8 million of capital return in fiscal year 2022 to date. I mean, at a $200 million market cap over the past 4 years, that's a lot of capital that's been returned.
Yeah, and they're mostly longer term debt things. They have a balloon payment, I think, in 2026, maybe, no, 2026, 2029. In that range, there's some balloon payment because they redid it from recently to go to interest only and stuff. But it's mostly long term, fairly low fixed rate. There's a mix of things. But as is traditionally things with these permanent planting stuff, it's very low cost of capital. If you have timberland, an orange grove, whatever, you can usually get some really good low cost of capital on that. So we'll see. I'll talk about it in another blog post. And the other two things to keep in mind is it was hit by a hurricane. They think, there'll be an update on that, I'm sure, but they think that that's mostly damage to this particular year and not damage for long term, that they permanently destroyed a lot of trees. And then the other thing is this was the worst year for Florida orange industry in terms of the harvest almost ever. I mean, it was terrible. So, but we knew that, and the government reports on that, and that was known. And it, a particularly bad harvest in one year doesn't mean that others will be, and that's usually due to like weather. Is why you have that. It's just weather things from one year to the next. So, the orange juice that you're drinking in the United States is probably a mix. In fact, it probably says it on it, of oranges from Florida, of which maybe this company might be at 10% or so of all the oranges that are produced there, for juice oranges, and Brazil. That's basically where it all comes from. Sometimes it's juice from both of those places because that, it would have to disclose that, I think. But there's some specialty ones that I think use California oranges or something, but they're not big brands. And actually, I don't think it tastes as good. But it's more expensive. This company, it basically supplies Tropicana. Mm-hmm.
Are you interested in this company generally, or do you actually think there's like potential to be an investment one day?
Yeah, I'm interested in this company. Definitely.
The reason I'm asking is because I think probably one of the most common questions we get, and I think a lot of aspiring investors or just people on their journey, they think about this a lot. It's like, where's that point where you finally pull the trigger, right? All things being equal, let's say, certain portfolio things or whatever. But here you laid out a situation where, they're returning capital. I would say it's a pretty defensible business. They have, some sort of moat in what they're doing. The equity value based on, what they think the land is worth and their business is worth. Well, just the land, I guess, is more than double what you could purchase a stake for in the open market. I mean, this kind of reminds me of those Buffett situations, the Washington Post or Disney that we've talked about, where it's like, well, you don't need to know the person's weight to know that it's that they're fat, right? What more math do you need? Basically, they're returning capital to shareholders. They have their capital allocation policy in place. They are shifting to a more professional organization. I mean, how are you kind of thinking about that?
Well, I haven't visited any of the company's properties or anything or the area. I haven't spoken to management, and I know nothing about the other major owners. In fact, there might be ways to figure out some of it, but I've tried to figure out a little bit and know very little about them. I've only heard kind of rumors and things and guesses and speculation. So those are kind of the things about like cap allocation from that, both just in terms of ownership and board and stuff, not just top management. And then the management and what they're really thinking other than what we see in the investor presentations. And then also seeing the property is more helpful, especially for seeing general area around the property, which, we've done for some other companies, is better for knowing long-term if there's a different higher and best use for some of the land. Because some of the areas, it starts to be built up by things around it, like we're talking about, with the ranch land or whatever. These are very, very low value things, sort of like timberland. Ranch land is some of the, lowest value land there is. So if anything starts to get fairly close to it in those counties and stuff, the possibility that the value of the land could be a lot more over time gets a lot bigger, because any other use can sometimes be a much more valuable use. They talked about here in one of them that, nearby one of the sales, there's something that's used for Walmart, which wanted something, and obviously they paid a lot more than you would get for the use of land normally, because they can put it to much better use in terms of what their returns on capital are and everything. So that's all things to be interested in. Also, you have the slide there, the mineral rights, because actually there's some like some of their historical land that they have is actually not that far in some places from some of the historical land that was the old Florida Rock. If you remember that company, which was, FRP Holdings and all that, there's a little bit of it that's actually close to that. So when they talk about like sand and all of that and the oil and gas things, there's some things that were used for other stuff. So because what they're talking about there is the mineral rights is that I believe that's correct. I'd have to check it. That they severed the mineral rights. So when they used to be much bigger landowner, in the history of this company. So similar to Keweenaw Land Association, right? Which used to be like 5 times the size that it ended up being. This company was much larger and then sold off ranch land and things like that. And so that you could end up with mineral rights that aren't on land that you own anymore if you sold the land without selling the mineral rights, obviously.
Mm-hmm. Would you think about the future value? So like the area around the land that they own is being sort of like a call option, right? Where it's like, well, that could only go up over time. Where it currently stands is it's, way higher. The value of it's way higher than where it currently is trading at in the market. And then over time, if things start to be a little bit more developed, that's a call option for you where the value of the land becomes much more valuable, or could become much more valuable.
Yeah. And with inflation over time, if it's sustained for a long enough period of time, and if you have a state and area that's growing more, then obviously the land can be worth more than what you estimated at originally. If you have a really low cost of borrowing and you're not really putting stuff into a lot of the land that you have, the ranch land, for instance, the value can hold very well because, you're paying in money at some fixed rate, and you're carrying something which has the potential to go up. And really hold its real value. So it's not a bad thing to have. And it's certainly not, if instead of land it was cash, people might look at the company differently, right? Because like I said, that would eliminate the debt. Like they do things like EV to EBITDA, right? I see people valuing on EV to EBITDA, but that to me seems strange because they're not getting a lot of EBITDA off of the ranch. So why are you adding the debt if the debt on the ranch is the same? The ranch land and the debt are probably pretty similar in value. If the ranch land didn't exist, then presumably there'd be more money to pay out to shareholders, and then EV to EBITDA of the citrus groves would make sense. I understand using EV to EBITDA on the citrus groves because the citrus groves are being used to produce the EBITDA. Now, they could still sell some of them sometimes if it has a much higher use than use of a citrus grove, but that's much more valuable as groves, and they produce a bunch of cash flow from that. But I just mean like on screeners and things, I think it would screen better or whatever if you took the debt away and the ranch land away, because the screeners aren't really capturing any sense of like value from the ranch land, but they are putting $100 million in debt on the company's balance sheet. Because most people aren't looking at like price to book or adjusting it for their estimate of the fair value and the net asset value and all of that. So it's the same as when we talk about timberland or any of those other things, or Maryland and pineapple, where if they just bought the land today and then the price to book dropped to half, it would show up on all these screeners and everything. But if the land is carried at old values, and so the price versus the fair market value looks attractive, it's not tripping things the same way and interesting people in it. So you kind of have to do those adjustments yourself.
If you look at the stock chart from like 1992, I mean, the stock, basically all your return has come from dividends.
Yeah, and you can see in the news, it says ALCO slashes dividend by 90% amid Hurricane Ian impact. So that's based on yesterday, presumably, and that's why the stock's down 10% today. And so that's why I'll have to write that up in the, in the week ahead.
Yeah, that's a very interesting situation, though. I like the business itself, and I guess shifting to a more professional organization, but also that's focused around capital allocation and being more marketable, I guess, if you will, to investors, right? They feel like clearly they're undervalued, and that's pretty interesting to see.
Yeah, the one thing I worry about a little bit with them is that the amount of investor presentation and everything, for a company that's it's all about land sales and about a highly cyclical and weather and everything based type thing, is kind of confusing for investors, and that any sort of guidance isn't really a great idea. I think explaining what you're doing and reporting on the impact of some things is fine, like of hurricanes and of a bad harvest or a good harvest or whatever. But it's a little bit like when we talked about universal insurance in Florida, where they give guidance absent weather events, absent hurricane and stuff, but a huge part of their business, is affected by hurricanes. This sort of thing is like, well, what would the EBITDA be in a normal year? They could tell people, but there's very good years and very bad years for oranges. And so people have to look at that. And I think like you're never going to attract a big base of shareholders who are interested in what EPS is going to be reported this year and all of that. Mm-hmm. So you really need more of like value investors or whatever, people who are interested in your capital allocation and your assets and all of that, if you want a good shareholder base here for this kind of company. It's not really the right company to be focused a lot on, let's give you guidance quarter by quarter and conference calls on that and all of that. I know that's what companies normally do, and that seems like what you would do to attract institutions to that, but I think it's going to be hard. And you see that like if you slash your dividend, then maybe your stock goes down a lot when it does, because you attract people for the dividend, of course. Maybe larger special dividends and things when they sell stuff would make more sense too. I feel like the regular dividend is really high, which is usually not a complaint that people have, but is really high compared to the actual cash flows of the business. Whereas they could pay out like more special dividends or large buybacks or something around sales of land and things like that when they have a better idea of their capital needs. Because it's not that they don't have enough capital. They're well capitalized and everything, I think, but I don't know that their EBITDA is all that or their actual cash flow from operations, free cash flow, is all that reliable from year to year in a business like this, where pricing and volume both move a lot. Like when I say it's a bad year for oranges, like the actual volume dropped by trees is low this year. So it's not just, what are the prices? This is really complicated sort of thing to have.
Do you think companies like this are better off being private because of that cyclicality?
Yeah, but I also think you can attract the right shareholder base. I think you just have to realize that your shareholder base is completely different from someone else's. But yeah, I mean, this is a stock that like a Third Avenue Value could have owned when it was Marty Whitman or whatever. It's a thing that, Peter Lynch, who liked asset plays as one of the categories of things that he could own that. But you have to attract people who are particularly interested in those things.
Could see Gabelli being interested.
Yeah, right. Exactly. Gabelli, right. So those kinds of investors who you could lay out like a sum of the parts and what's your capital allocation and trying to kind of increase over time what we think, the quote unquote intrinsic value of it is, or at least like what the fair market value of our assets are, plus, all of that, to kind of like show the ongoing liquidation value of the company, even though you don't intend to liquidate the company, that over time, if it's going up or down, I think that makes a lot of sense. The EBITDA thing, although EBITDA is what everyone uses, I think is a little tricky because, no matter what, it's going to vary a lot based on things like volume and pricing. And you could have a year where you have bad volume at the same time you have bad pricing because, like I said, it's not all from Florida, from places there. And so if there's a big harvest in Brazil, but a terrible year in Florida, that might hurt you particularly badly. Whereas you might get lucky and have a year where production is strong in Florida and it's not in Brazil or whatever. And then you have strong pricing and strong volume.
So on this Why Invest in ALICO slide, it says 42% institutionally owned. Do you have any sort of knowledge about the shareholder base? Is it larger funds? Is it like a controlled entity?
Right. So I do have some knowledge of it, but I don't know a lot about anything about the people who are involved with those things that owned a lot of the stock in it before. There was an agreement with it, which I take it is sort of like a unwinding of a partnership, I think is probably the real reason why that happened, but I don't know that exactly because the ALCO part of it doesn't really explain that, but that certainly seems like what happened, that shares were distributed to people through the fund that originally owned it together. And I don't know much at all about that, but there was obviously a changeover in control in the sense of actually administering the company, although not necessarily in terms of a lot of the ownership of the shares.
Very interesting. I would love to go see this. I mean, orange groves, come on, that looks beautiful. I should say that we do not own ALICO, but so do your own due diligence. But that is a stock that you could also read more about it on Focus Compounding, not just this blog post, but Geoff actually laid out a thesis. February 7th, 2021. Instead of Florida, orange grower selling land, paying down debt, and focusing on its core business, which is true as well. I know when I did reference most of your return has come from dividends as an equity holder. That is true. But they have also paid down debt. So I guess from like a enterprise value standpoint, but as an equity holder, most of your dividends have come from, or most of your return has come from dividends. But this is interesting, right? We've talked a lot about MLP on this podcast and throughout Focus Compounding's history. Yeah. And, it's different because they're actually monetizing the land a little bit more. MLP is really a controlled land bank that, like I said, emphasis on controlled, and it doesn't seem like there's any sort of emphasis or motivation to monetize the land. And it looks like ALICO is trying to do that in some way or be just more presentable to investors. I don't think Maui Land and Pineapple cares at all.
No.
Let's go back to the homepage. So you also wrote a blog post, What to Read to Learn More About Disney. So we speak a lot about Disney on the podcast, and you laid out 3 books that you recommend: The Ride of a Lifetime by Bob Iger, Disney War, and Walt Disney by Neil Gabler, which covers Walt's life. Great books. Disney War is great. I want to reread that actually, but it's one of my favorites.
And I also mentioned for the company as it is now, and to learn about it all the time that way, The Science of Hitting, which is a Substack. That's a good one to read because it covers a lot of media and things like that, and Disney in particular. So those books are, out of date. The Iger one is the most recent, but they're obviously out of date in terms of the exact way of what the company is made up of and everything. But to know the kind of the history of the company and the history of the assets that formed it, those 3 books I've read, and they're very good. I think people would enjoy all 3 of them, probably. Yeah, Ride of a Lifetime would be the easiest. It's not a particularly deep book, particularly hard read, and it's the most recent, so some people will be most familiar with that way. Disney War is kind of the most famous historically, because it's a bit more of an ugly situation and all of that.
It's a fun read.
Yeah.
620 pages.
Right, but what people might overlook on that is Disney War is probably about only half the book or so is really the part about the Disney War part of it. The other half is sort of the good part of Eisner's reign there at Disney. So it's actually a really comprehensive book that way. And then Walt Disney is it's a very good biography, very comprehensive biography of Walt Disney.
Mm-hmm. And The Science of Hitting is a good follow on Twitter as well. But speaking of books, you also did a blog post about 6 books I've read recently. And, I have a question. Where do you find, and somebody had actually texted me, they're like, where does Geoff find these very obscure books, right? Limping on Water, Beating the Odds, Ski Inc., which I actually, out of all of these, you did recommend reading Limping on Water, which I have read. The next one I want to read is Ski Inc. But it's like, you say a manager's account of running different ski resorts in the U.S., like Limping on Water. This is basically just about the jobs he held and what he had to do. So I just thought it was interesting, right? I've never come across this book before. I mean, are you just kind of like, does Amazon recommend these books to you just based on different books you've read or people bringing you these books? I mean, how do you find these very obscure, interesting business books?
Sure. So some people recommend them to me. So I get that sometimes. Those are some of the most obscure because people research something or whatever and they recommend it for that reason. There are places where it's been mentioned before. I don't really use them anymore, but like there was, and I'm sure there still is, a thread on Corner, Berkshire, and Fairfax about books. So there may be things like that where people would recommend it. So then you could check those. I also use the bibliography or the works cited of books. And when reading a book, I take note of any books that they mention that they're sourcing it from, that they're quoting from, or that there's a footnote from or whatever, and then look into that. And so that would help with finding things connected to the same company or the same story. And yeah, Amazon's gotten much worse this way though, because Amazon's taken on a lot of advertising, and so it has all these sponsored products things. And so now finding things that are recommended just because they are actually what is related to what you might want to read has become harder because they put a lot of sponsored products above that sometimes, and sometimes they actually even get rid of that section for it and replace it when there weren't a lot of books there, and replace it with all sponsored things, which are basically just, they'll just show up as just business books and stuff because no one's buying advertising for really small books. Great Texas Banking Crash is probably from the blog we talked about on banking. They had a list of books, and so I read some of the books. I think I have like most of them or something from that site, and that you could get your hands on. And then I read a lot of things in print, obviously, so that varies sometimes where you can get used books and whatever. Like in this case, here it is for $6 or whatever plus delivery, not very expensive. There are others that are really expensive because if demand, if it's never been printed again, which happens with smaller books.
It's like margin of safety.
Yeah. But I think I mentioned the Teledyne book, the Ben Graham's memoirs. A couple of those things are very... at times get high priced, right? This is impossible. It's a $2,000, the one you're mentioning, margin of safety. But even other ones like I said, the Teledyne book that I mentioned, I've kind of not recommended to people that they actually spend it because it's a very dry book for what they'll get for spending, whatever it is, $100 or whatever. And the same thing with Ben Graham's memoirs. While I enjoy it and everything, most people are going to find that it's a lot of money to pay for something that is a lot focused on not his investment things, because that wasn't necessarily the thing he was most interested in.
Let me see. Last time I checked, this book was like a 10-bagger for me. The Focus Investor by Richard Rockwood. But it looks like there's no price on that right now. Auto print, limited availability. So I don't know. But, once upon a time, about a year ago, I came across it and I was like, whoa, this book's been a 10-bagger for me. Let's hodl it. Let's hold on and let's see where we end up in 10 years.
Yeah, and so there are other websites you can go on to that sometimes are even better for buying books than Amazon for when they're out of print things and all of that.
Like what?
Well, not only does Barnes & Noble have a site, but there's also, what is it? A-Books, something like that, yeah. Which also will connect you to a bunch of used things. Amazon, for ones where there was originally printed pretty big, does have a pretty active used market. So, I think all of these were bought off Amazon. Yes, I was able to buy all of these on Amazon. So, Limping on Water, Beating the Odds, which is the ABC story, which has a forward, the introduction by Warren Buffett, by the way. Some of these are also funny because they're, the author has written something on them to somebody. So who knows what that's all about. But like, so my copy of Beating the Odds, for instance, happens to be one of those things.
So like, as in like you bought it used?
I believe, do they have it? Well, it says now that you can buy it free, but buy it new, I guess. But yeah, I bought it much lower for used. Yeah.
Yeah, $1.68. I always buy used personally. It doesn't bother me. And honestly, I like to see what other people have, either scribbled in the margins or what they've underlined. And again, like here's a perfect example. A new book would cost about $40, but you could get a used one for $1.68.
Right.
I like that trade-off.
Right. For books where weren't a lot printed and stuff, often the used ones are a much better purchase. It mostly just matters who the seller is. So if it's one of these sellers that you're used to, that whether it's like Goodwill or Thrift Books or something that's very large in certain places and you've bought a lot from them, and that works out fine. For some of the other ones, it's not as good. But to be honest, I've gotten more problems for buying new things and stuff from Amazon sending me the wrong thing than anything else. So the used books have generally been fine that way.
Mm-hmm. How was Ski Inc. though? Was that a great book? Out of all these, which one was your favorite?
I think you would like Ski Inc. My favorites were Power Failure and Beating the Odds.
Power Failure. Okay, yeah. So about GE.
Yes. I liked Power Failure better than Lights Out.
Interesting.
It's very comprehensive, though. It's very long. So it is
816 pages.
Yeah, but it's like 100 and some pages of notes. It's like the snowball. I mean, I think the actual thing is maybe 670 pages. I don't remember exactly. Maybe it's low 700s. It has a huge thing on the notes. So that's a history of GE for the entire period, but mainly it's focused on, more than half the book probably is just Jack Welch and Jeff Immelt. And then the other part, though, is the original, how it was created and all of that up to then. So it is interesting that way. If you really want to know sort of what happened in those, 30 years or whatever that the two of them were in charge, closer to 40 years, I guess, then that's the book to read, I would say. So those are the best. I mean, a history of the whole company is something that I would love to read. I would love to have a history of capital cities from the beginning till it was sold to Disney. I'd love for a corporate history of Disney, not of Walt Disney the person, but through the entire period, because interestingly, there are gaps really in the coverage of Disney. There, from a corporate or financial perspective, there are pretty big gaps between the time that like for instance, there's very little coverage in anything except contemporary reports about what happened between the time that Walt died and that Eisner took over. Like very little about the situation the company got in. And so this period about sort of a decline in Disney's prospects is not really well covered by anyone because they don't really go back that far and talk about all of it. They talk a little bit about it, in Disney War. They talk a little bit about it with other ones. And there's a lot of coverage of it from the perspective of what Disney was putting out. So there is plenty of perspective from the people who like Disney films and, criticize them and whatever and stuff like that. But not from a corporate perspective. There's very little information about that. So there's actually no real good book that's a corporate history of Disney as a corporation from beginning to end.
What year did Walt Disney die?
Let's see. Around 1965. I don't know the exact death year. He would have died within a year or so of Buffett's investment, a year or two. So when would Buffett's investment have been? Buffett would have been before... He's still on Berkshire stock, actually, we know, but did some Disney stock in Berkshire, but presumably he sold or whatever when he wound up the partnership. So around then.
It says that he died December 15th, 1966.
66, okay.
Have you gone to this resource before? I don't know if you've seen, I know I did email it to you at one point, but there's this huge collection of archived annual reports from a bunch of America's greatest companies, and they have like an annual report. Jeff, you would like this, especially like when you're reading these biographies and stuff of, in this case, Walt Disney. The annual report from 1966. There's an annual report for Disney from 1965, 1975, 1955. Wow. But kind of cool that you could just go and there's this huge collection of archived annual reports. I mean, this is 40 pages. So, I mean, it literally has, the whole thing in there. So if you want to, I don't know, to your point about getting more information about like the corporation itself, I'm sure you've come across this, but this thing that I tweeted out has all these, old archived reports, which I think is fun just to spend time in. I think the oldest one that was in here was like mid 1800s or something. I mean, it was, very, very old. So it's cool. I mean, just America's most common companies. Yeah.
So you retweet that or something so people can see it?
Yeah, I just actually tweet out because I'm creating a collection of just like the best timeless investing content on the internet. I tweeted this December 6th, the last week, and that is on there, that archive.org drive, I guess, if you will. And I'm just going to continue to add to that. So anyone that wants to get access to this collection of looks like 1,331 different annual reports, some of them going back to the 1800s. You have the Quaker Oats Company from 1920. It's fun to read like in the context of what you're interested in. So if you're interested in like inflation, you could go back to like inflationary times and read what each company was basically thinking about, their projections for the future, how they were communicating and stuff like that. I don't know. I just think it's a cool database of like history of different companies, over the past couple hundred years. So I think you would like that, Geoff. Like, for example, typing in Disney and getting more information on that. So a couple of podcasts ago, you had said that one thing that you think people would be surprised to learn about as it relates to your investing process is how much books are part of the process. So can you like take us through like sort of your playbook, if you will? You come across a new company, you're not familiar with it, you read the annual report or the 10K, 10Q, maybe some transcripts, or just get caught up on the business. Do you from there go to like Amazon and type in said name to see if there's a book written about it? I mean, we've spoken a lot about NACO on here, and you purchased a book about NACO's history, right? Yeah. So like, do you just kind of come across it in your research? Do you always look to go out and find a book that is either on the industry or other companies in the industry, competitors, etc.? That's a huge part of your investing process. So take us through that for anyone that wants to replicate what you do.
Yeah, I certainly do that. Most of the companies that we invest in, everything obviously don't have books about them, but there might be books about the industry and about other companies in it that are close to them. So, histories of the industry, but particularly histories of specific companies are the best thing to do. So even if it's things that are, that you're looking to invest in, Arc Restaurants or Flanagan's or whatever, reading about trying to find any other companies that are in the restaurant business and everything is helpful for that, sure. And that's true. There were books written on DreamWorks as a company overall, not DreamWorks Animation specifically. But DreamWorks Animation was a public company, and so you could read those, but you could also just read about movie studios in general. The ones that are really interesting to me are ones like Ski Inc., obviously, because there actually isn't that much written about the industry from a business perspective. I think I mentioned with the cruise lines, there's some stuff about it in about sort of cruising and stuff like that, but from a business perspective, there's probably only like 2 good books on that entire industry that I can think of, and it's a big industry, so there's some surprising gaps that way. The movie theater business, for the most part, you get it through reading books about other people who were involved in it for a while. In Beating the Odds, the company that became ABC, that bought that network, it wasn't called ABC at the time, but that bought that network, was actually involved in the movie theater business. Viacom, Sumner Redstone was involved in the movie theater business, and so were some others. You read The Outsiders, one of the companies in theirs in the movie theater business, but obviously, you can read these annual reports and things about them today, and you don't have a lot of that background. We've talked about theme parks before. There's lots of there's lots of write-ups on Value Investors Club or anywhere else about them and using data from the industry and stuff as it is now. But you need to read books and things to get an idea on what the industry was like before, to get an idea of how mature it is now and how slow growth and everything versus what it was like a long time ago. And sometimes you figure that out just because you're reading and you're like, well, that doesn't really make sense. It must have been very different before. Like the cruise industry was once a very rapidly growing industry, because you can see the huge size that it's at. You can see that it wasn't started that long ago, really, when you think about how many decades ago. And yet it's this slow growth, whatever thing. Now it can really lead people to think that somehow the industry doesn't change over time. One of the biggest things is people say, like, what's a good business or a good industry? It changes over time. As the industry matures, there's certain parts in its history where it's a really better business than you might think, and then there are other parts where it's not as good. People will say like a newspaper is a great business or something. It wasn't. Throughout most of the history of newspapers, most newspapers were terrible businesses. It's that there was a period where there became dominant daily newspapers, one per city, and they became really successful. But, these things were founded often a very long time before then, didn't make a ton of money for their founders in a lot of cases. It was a much more competitive business and faster growing and everything, but it was during the period where Buffett was investing in them and all that in the second half of the 1900s, which is when really, they made a lot of money, and even not particularly good ones, as long as they got to be the top one, or in a few cities, one of the top two, was a successful business that way, right? And so it's true with all of these. And you can see that even like, that's one of the things I enjoy with Beating the Odds, is because of how different the network TV business was, how different the movie theater business was, how different all those things were back then versus what they would become later. And you get that from reading Buffett's shareholder letters and stuff. I think his 1990 letter or around then, he talks about how maybe it was 91, I don't remember. But he talks about how the economics of the media industry haven't just deteriorated because of economic downturn, but also because the economics of it have really changed. And that's when he's talking about cable coming in and, other things like that. So already he's talking about that in terms of newspapers and local TV stations and network TV, whereas people think of that as being the internet. That's just why that happened. But already he's talking about how it used to be a great franchise and now it's just a good business. It was once a franchise, something with a moat and everything, and now it's a better than average business, but it's not, one of those sorts of things. It's not a Coca-Cola. It's not that kind of business anymore.
So more on Coca-Cola. Why do you think it took Buffett so long to invest in Coca-Cola, right? So we're just sort of talking about the life stage of an industry or companies where we've done so many podcasts on this before, but Buffett's typically interested where it's about slower, more predictable, dominant growth. There's a few main companies or players in the industry, and it's much more about capital allocation and market share growth, right? Or maintaining your market share, I should say. So why do you think it took him so long? I mean, he read 30 or 40 years of Coca-Cola annual reports. He lived next to an executive. Why do you think it took him so long to invest in Coca-Cola?
Well, one, it wasn't cheap. So that I think was part of it. It had a history of being pretty expensive for much of that period. It was a nifty 50 type stock. So the business did really well in the 10 to 15 years really before he bought it. But the stock actually did not do that well. So that's part of it. So I think it's one of these where like the economics, the fundamentals were catching up to the stock price over that time. And so that definitely helps out. And so that I can relate to that because I've certainly seen things where I think, oh, this is a great business, and it takes years and years to come down while the business is growing at 15% a year or whatever, and the stock is flat to down a little bit over many years before I realize, oh, this is a stock that we could buy now. Because I had thought of it as a really expensive growth type stock. It was the opposite of a value stock, right? Even from the period of Ben Graham, they're already thinking of it as a blue chip, growthy, whatever type thing. It's the absolute opposite of a value stock, as was like GE of that period and things like that. So it's mentioned early on that way. Even I think in Beating the Odds, there's something there about... wait, do I mean Beating the Odds? No, sorry. I meant, I guess, no, I don't remember which one I meant. But anyway, so Coca-Cola stock had already performed very well by the middle of the 1900s. It was already something that was whatever you could go back and find if it was a 100-bagger or whatever before then. So it was a fairly flashy stock in a way. Certainly very well-known company that way. Buffett had owned a little Wrigley, and he'd owned Disney, because we know that from seeing things in the 60s. So, he owned a little bit of consumer brand things. He did buy into food things, but those were very, very cheap when he bought into them. So Coke was really a different experience in terms of the price that he was willing to pay and everything like that, I think. He was willing to pay it for things like the Buffalo Evening News, pay a really high price because he really understood the news business, right? The newspaper business. And he knew exactly what he was buying, and he was getting control in that case. Maybe for a Geico or something, he didn't have to because he bought it when it was severely distressed. But, would he pay a high price for that? Maybe, because he really understood that. Coke, I don't know if he felt that that was something that he had such great understanding that was in his circle of competence that it was something to pay a lot of money for without learning a lot about it. So I think, although we think of him today that way, I think probably it's from the time he bought See's till the time he bought Coke that really makes sense as the transition from it, right? So Coke as a stock is not doing that well. Coke as a business is doing well. He's owned See's long enough to really understand the value of a consumer brand that way, and raising prices and all that kind of stuff. And then, there's a change in management basically, that's doing some things that he likes in terms of getting rid of the diversifying that they had done before. Because remember, they own a movie studio, they own a few other things too. So getting rid of that. So I think a combination of all those things, but it's not as crazy as it sounds that like in those 15 years or something, he hadn't bought Coke before then. And then you think, yeah, he could have bought it from, when he was buying American Express, he could have bought Coke. They're just in the 60s, he could have been doing it or whatever. But, it was an expensive stock for much of that period. And that wasn't originally the area he thought of himself as investing a lot in, his consumer product stuff. He'd have success with Coke and Gillette, but that wasn't really, and now we think of that as being so much a Buffett thing to do, right? But like his whole history, most of the stocks he was buying were not things like that.
And power failure, would you consider Jack Welch a great CEO, right? After all this information that's come out about the business, it's interesting because he was, put up on a pedestal, even by like Buffett and Munger, right? They always talked about how great he was. I'd love to hear what their updated thoughts are on Jack Welch, just because of the incredible amount of information that's come out about the company really since he's died.
Yeah, I think that he was a very good CEO. When I was trying to think before, when you were asking me about Bob Iger, was Bob Iger a great CEO, right? I was thinking, who would it be that would be listed there who wasn't a founder and everything? I could think of many that were founders or early on, but Jack Welch is someone who takes over long after the company had been around. I think, look, he actively managed earnings in an aggressive way and managed Wall Street's expectations and set up things that could be a problem later on that way. But I do think that it's really overstated the extent to which GE's problems later on and really failure and everything are a result of the situation that Welch left the company in. Yes, he grew the finance part of the business to a lot bigger part of it. But that doesn't necessarily mean that you're going to have a disaster. To some extent, I actually think that it's slightly overstated, both in the case of Greenberg at AIG and Welch at GE, that they were responsible for the company's failures just because they bought and grew. They really grew into a huge size, the units that eventually would cause the downfall, because I don't think they would have caused those problems had they been in charge at that time. The capital allocation of Immelt was particularly bad. And also there's just other things. The stuff that GE's culture and what Jack Welch did with GE did create a bit of a problem in which, because they were focused on earnings and managing earnings and everything, I think over time they ended up putting more and more businesses and growing businesses where it's easy to manage earnings, both in the sense that they can consistently grow and everything, and that you can rely on having a low cost of capital to make money on a spread, and that you can manipulate the earnings basically even in things like the jet engine business and stuff with the service contracts. So even in things like medical and aerospace and stuff, I think that that's part of it. And I think that's actually one of the reasons, it doesn't get into it in this book, but I do believe that's one of the reasons why GE was really willing to sell NBC, is because the media business that they owned is actually really difficult. NBC and Universal and everything is all of that stuff that's now Comcast. Those sorts of businesses, even if they branch out into other things, are generally very difficult to manage earnings in. They don't necessarily give you very consistent earnings, though if you're diversified enough in it, maybe they can. But they also have earnings and cash flows that are really much closer to each other. So you can't kind of take something over and not value it on sort of a cash flow basis and have it instead on like an earnings basis. There's nothing that you can do. I mean, there's one story in Power Failure that is kind of funny in that they're talking about one of their cable things that they owned. And they were saying to them, oh, well, for this quarter and stuff, could you maybe release this movie right after Christmas instead of right before, right after the end of the year, after December instead of right before? Because the way, if you know how accounting works for movie and TV and stuff, is that you have to match off revenues and expenses. So although you've put in all the cash into it, let's say you have a $100 million movie, you've put up all the cash up front, you actually haven't reported any of that as expense yet. Now, if you play the movie once on January 1st or whatever, you think it has no value at all after that, it's a flop, you have to report the entire expense immediately to match it up with the revenue. If you think the revenue is going to be smoothly going over 5 years, then you would report it the same way on the expense. Basically, you're giving it like it has a similar margin on it over time by matching off the proportion of the expense to the proportion of the revenue. So when you have a huge hit, you get a profitable hit from that over time as it smooths out. Or if you have something like the movie that Disney just put out, Strange World, that thing, because the revenue goes away, they model that the revenue is going to go away like almost instantly. It's plays for a few weeks in the movie theaters, and then we're not going to make any money on all the rights for it and stuff. They just have to take that expense like that. So this company that GE owns, they're saying, okay, so can you do it right after in January instead of like a week before or whatever in December, because that helps us for the quarter. We need a little bit more this quarter versus last quarter. Whereas sometimes in the reverse, they're like, you can take more expense this quarter, right? So they have to even it out. So the problem was it was a Christmas movie. So they said, no, we can't play a Christmas movie in January. It's coming out for Christmas. But that's the kind of thing that they would do, right? So they would pull back in one unit in terms of like, can we pull forward some expenses and stuff so we look better in the future? And so basically they call around the company and be like, we've got a $10 million hole or whatever. Where do we find that? And how do we make that happen? And so in the kind of idea of like good money, bad money, pushing out, crowding out the good money, I think over time, bad businesses, because GE was also active in how it managed its portfolio of businesses that had particularly good cash flow characteristics versus particularly poor earnings ones got pushed out of GE, and ones that had particularly good earnings versus particularly poor cash flows got kept because they were concerned with their earnings that they were reported. They had access to low-cost capital, and they were willing to grow their balance sheet as much as it took. So all they cared about was earnings per share. And no one was saying, what's your free cash flow? What does it look like and everything? So a business that actually to Comcast, who probably manages their business, they do now. I mean, when they were early on, they didn't necessarily, but they did embrace sort of the John Malone type approach to cable companies and stuff. So for a cable company buying something that has that kind of cash flow and everything, they're just looking at what's the EBITDA, what can we get out of it and all of that. They're not worried about what are we going to report in earnings. And so they got rid of some things that actually would have had plenty of cash flows and stuff into things that were all about the earnings per share. And so that's part of the thing with the financial situation that they got themselves into. And it is something that is similar both with AIG and with GE. And I do blame them for creating, in each of those cases, the star CEOs, for creating the circumstances that would happen later, and especially the culture that would happen later too. But to some extent, I think that Jack Welch set up the situation in which a not very good CEO could do some real damage. I don't know that if he was the person who was always in there, that would necessarily be a problem. But
you mean like as it relates to like manufacturing earnings and stuff like that?
Yeah.
Like the constant need for like needing to beat the street. What is the Wall Street expecting? Beat those expectations, keep the dividend.
Yeah. Now, the thing that Jeff Immelt couldn't have done anything about and that Jack Welch gets too much credit for is that GE's stock was just really incredibly highly priced at that moment. Mm-hmm. So from a stock perspective, things did not go well. But honestly, from a corporate performance perspective, it also didn't do that well. And, you know, the financial crisis was actually, I mean, Jeff Immelt took over the company basically around September 11th of 2001. You know, that's the easiest way to date it. It was right around then. So there's actually several years until the financial crisis, right? Mm-hmm. And likewise, the energy, a huge decline in energy, you know, in the U.S. that happens later too, is like a dozen years into his tenure, right? So it's like half a dozen years or something until the financial crisis. It's like a dozen years until energy turns down. They bought a big energy thing. You know, those are decisions that they made as a company that were not necessarily that smart. And they took a lot of the worst things of the Welch era and didn't have a lot of other ones that were better. But overall, GE was definitely run throughout as the anti-outsiders type company. If you like read the book The Outsiders, this is the reverse of that. If all you worried about was reporting good earnings, you didn't care about the cash flows and all of that. And there's a lot of things about how the accounting works and how you manage to those numbers that's a problem. And I've also talked about that. You know, so because of if a number becomes something that you manage towards, then it's not as reliable as an indicator for outsiders, because you're managing that. So like EPS became not that useful in understanding GE. Likewise, the company's like culture in terms of its management, I think they were not, they didn't have a great understanding of cash flow stuff because it's not how they ran the business, whereas like Teledyne did. So there's a poor understanding of cash flow and a poor understanding of return on capital, of what capital costs. And that was something that I started under Jack Welch and continued with others. GE. Although even before then, they weren't particularly. I mean, all business was run very much towards earnings per share stuff. Big giant corporations like GE, and not worrying a lot about returns on capital and certainly cash flows in the earlier days. But GE was run very conservatively financially. Then with Welch, they became a lot less conservative financially, and so Welch did inherit very strong financial position and caused that financial position to deteriorate. You know, GE shouldn't have really been a AAA rated company when he left. So that part is true. But, you know, every LBO and every and most of the outsiders, with the exception of a few, did the same thing, right? They started with a company which was somewhat normal finances and brought it down to like a junk bond type company or whatever, and focused on return on capital, especially on cash basis, you know, the cash flows and all that. But they focused on getting the equity performance to be as strong as possible and acted like owners. But they didn't focus on having this rock solid financial situation, except for Buffett. And they also talk about Washington Post there with Kay Graham, but that's because Buffett's really having a huge influence there.
Do you think this whole idea of like being worried about future earnings and communicating your company to analysts and Wall Street and quote unquote beating the street? I mean, do you think most companies, I mean, take Buffett out of this mold, most companies kind of operate that way and worry about those sorts of things? Kind of like the whole, you know, Buffett quote of you get the shareholders you deserve. Would you say most companies kind of fall in this same bucket as GE?
Yes, but I have to say, since I lived through it and you did not really, it was so much worse in 2000. That's what people don't understand about Enron and GE and all of these that were at that time, and that were a lot of the Sarbanes-Oxley stuff after that, Tyco, whatever. This is what all companies big size did there. It was a complete focus for them. Obviously, they changed some things about disclosures and what could be given to analysts instead of others. But basically, there were whisper numbers and there was guiding to certain consensus there. They didn't have to, no one had to pre-report that, oh, we're going to have a bad time like Snap and stuff does now, because they could get all the analysts on board to guide them to the right numbers before then. But yeah, it was an obsession with everybody about the earnings per share thing, about the, and there was a ton of value to that in people's eyes of the consistently growing best businesses, the higher returns on that. I mean, GE was very, very famous around 2000 or so. And it's amazing because it was very famous as a successful business and everything at a time when it was the exact opposite of all the tech companies and the new things and stuff. This was an old company that was not in any of those businesses. Even the things that it was in that were high tech were things that were decades old, those industries. And so it was, it was because of that, of the consistent earnings results and all of that. And it was like the Nifty 50 type period. It was a similar sort of mania that caught on. And I think people forget that. They remember it as like the pets.com and stuff like that. That was what happened then. But there was this blue chip boom that happened too. And a lot of the wealth that people lost in the downturn of the 2000 bubble bursting and everything was not just tech stuff, although some of that were really bad. We've talked about like Cisco or whatever, like that got to a price that could never be overtaken, no matter how well the company was run from that point on. It was just, you would never get back to that stock price and stuff. It would never be a good performer. Microsoft was bad, but it wasn't as bad as Cisco in terms of the valuation. And so it was, but it still lost a decade or whatever we looked into in terms of the stock price of, not taking over a decade to turn around. So yeah, it was just that period that was unusual that way. I mean, you saw the only thing that's similar to that, there was a housing mania that you saw in, and everyone's right about and stuff now in the housing boom, and like learned about after that what that was like and how strange that was. And you saw that in the TINA or whatever you want to call it, the FOMO, that morphed into a few different things in terms of what's been crypto and SPACs and certain completely profitless tech type things that are basically like pre-revenue or startups that have not clear how they're going to commercialize and all of that of the last few years, which I really just started in the last years before COVID, the first signs of it, and then happened, with COVID. And that's common with all these, that you get a bunch of little bubbles in different things, even with the Nifty 50 things and all that. When you look at the history, there's these little bubbles of different things, and like some of the more speculative things, that bubble pops and then another bubble pops up that's even different. So it's one of these really interesting things because like 2000, interest rates were not that low. So, the bond yields were actually pretty much I think they were in line with totally what they'd normally been for a long time at that point. They weren't considered particularly low. Short-term money definitely wasn't low at all. And then tech stuff. Okay. If you believe the internet was going to become the biggest thing ever, that makes sense with Cisco, right? Selling, basically the sort of, switches, sort of the infrastructure of what the industry was going to need and everything, and a couple other ones. But why is GE priced so high? Or, there's others. There was so many of them. Even, Coke and Gillette got to prices where Buffett said that they're overpriced. And that bubble is not the same thing. It's just something psychologically that's happening with people. That's interesting because it's not just logically making sense. But people justify it. But now, people have talked about until rates went up recently, right? They talked about the net present value stuff. So it's the discount rate. Well, the discount rate wasn't that low back then. So it was all about the internet and that growing fast. That makes sense to a certain point, but then there was all these companies that actually weren't even that involved in the internet. And so you come up with different ways to justify it. But what it honestly was is that after, rates peaked in like 81, I guess, or around then 82, the stock market starts taking off basically. And it continues to take off for like 17 years, basically. There was a crash in there and everything that was momentary. But at the end of that, you still keep feeling positive about things, and there keep being things that kind of develop out of that. And you have a memory of it being so positive for so long. So it was a very, very strange period that way. And that's something that probably Power Failure could have done a better job of explaining, though it did a little bit of a job explaining it, that people don't realize that of what's changed between like now and then. Like more recently in the last few years, being in the right thematic category, that's the thing that's been hot. So it's sort of like the uranium stock craze that happened, 50 years ago or 70 years ago or whatever now. That sort of thing. That was not what was really the huge thing 20 years ago. It was actually these stocks. It was a few leaders, these big name stocks that everyone was crazy about. And some of them were internet stocks and some of them were just big leaders in their field and whatever. It reminds me more of like when they talk about the stock they called radio, but it was RCA back in the 20s and stuff when it was a hot growth stock and everything. But it was also considered a well-run stock and just a popular leading stock, and everyone looked at it and there was that's what everyone traded, that's what everyone talked about. So, and it's also hard to understand when I say things about like Activision or whatever, why wasn't that stock bid up to the moon? You would think that with internet and video games growing so fast and everything, that would be a crazy thing. It wasn't big enough, it wasn't a leading thing, it wasn't well known enough. It was an interesting period that way. And all the magazines or whatever will put certain stocks on the cover of it. And it's hard to remember that too, that there was a time when being on the front of, Forbes or Fortune or whatever and having articles in it, Barron's and all of that was really important to the level of interest of people in your stock, institutional interest and all that. And then the analysts covering and then getting out to people generally. And that was what it was all about instead of, Reddit or whatever. Right. But it was. And he was a celebrity. And Immelt was a celebrity, even though he, never did a particularly good job at all.
Was he a celebrity, though, just based on Jack Welch's shadow, right? He sort of inherited that celebrity.
Yeah, and he was...
Which obviously he cared a lot about.
Yeah, and he was a very good person to have on interviews and things. It was a giant company, and it covers the kinds of things that people interview and people want to hear more about, which is the more macro type things, not the details. He didn't seem like he was a very details person in any interview that I saw with him. A very big picture person, that's always what they're interested in and what they can talk about to have you on something. So just a kind of ambassador for corporate America or whatever,
Mm-hmm.
Yeah.
I will say the titles of these books are just incredible. Power Failure, Lights Out. I mean, it just seems like there's just so much material there because of the situation, right? Like they're kind of going with that theme.
Yeah, absolutely. Yep.
So getting back to reading books being a huge part of your investment process, I mean, to really add some context around that, if you had to guess, how many books do you think you read per week on average?
Only 2.5 or so, I'd say. I mean, I say that I read a book every 3 days. That's not really exactly true. I'd say more that I'd never go 3 full days without having finished a book. So some books I read in a day, some 2 days or whatever, but I can't really remember times unless I'm doing something unusual, where I just don't have any time to read. Yeah, basically, I always finish a book within 3 days. I'm on to a new book.
Yeah, I don't think people understand. I mean, like your quote unquote default boredom, right? Like your default mode that you go to when you're not actively doing something is pulling out your Kindle and reading.
Yeah. Mm-hmm. And I have things set up to be able to do that. I mean, right now I've got a heater on my back patio and stuff, the propane heater and stuff, so that I can still be out there reading and getting time in doing that, even though it's, December or whatever. Now it helps that it's Texas, but we still do have some bit of winter here where you can't be out at all hours and stuff. So
you're a big porch guy. You like to sit outside and read.
Mm-hmm. Yeah. And I do. I have a bag that I bring around with me everywhere that has usually at least the book I'm reading now and then a backup book, right? So you don't really need more than that usually, like you can have your Kindle and take it out anywhere when you're on planes and things, and maybe it might be a big thing. But usually if you have a book and a backup book with you everywhere, that's what I take out. And I don't have a phone. So in the place, if you imagine all the times people would use a phone, take out a phone because they're waiting for something, whatever, I'm reading a book. If you replaced all the time you take on a phone with reading, you'd probably finish a book every 3 days at the most. I think that's true for most everyone. I don't know estimates of how much time people spend on their phone each day, but historically, certainly like say a decade ago or something, people were spending 4.5, 5 hours a day watching TV, before smartphones got big. So if much of that's gone to smartphones and stuff, I mean, you replace that with reading, Kindle estimates how long it'll take you to read a book. There's not a lot of books that are going to take you more than 15 hours or something to read. So a few days, yeah. My biggest thing is getting enough material of the kind that I like. So, like, for instance, Power Failure and stuff, I have to read these reviews to kind of figure out, is this really just like a hit job? Is this really something that they don't have any access to the company? Is it going to be all about like, am I going to get like more of a social history or a history about, they're trying to tie into some bigger idea that they have about capitalism, socialism, environmentalism, politics, whatever. Because the publisher's always going to pick a name that is going to get people in there in a cover, and it's going to sound more confrontational and, whatever, about either glorifying something more than the book really does or whatever. And so some of them, you think this is not going to be good at all. I mean, like, what's it? Devil on the Blue Seas or whatever. Devil. Yeah. Is actually a much better book the cruise book than you would think, because you think it's only going to be about like them dumping waste directly into the ocean and different scandals and union relations and whatever things that they're famous for. But
on the Deep Blue Sea.
Devils on the Deep Blue Sea. Yeah. It's actually, a much better book that way. And then I read another one that was from someone who was in marketing and that and whatever, but you get a few different ones. And Devils on the Deep Blue Sea. Yeah. So, but of course that book is published, what it's saying is published is right before everything changed in the cruise industry, because you have the bursting of the financial bubble and everything. And since then it's gone to a super slow growth industry. But yeah, and Selling the Sea, I read that one too, and those two books together is pretty good to understand the cruise industry, I think. Yeah, but from the titles, you don't always know what's going to be a good book that way. The Great Texas Banking Crash, for instance, I did not like that much because it was just a book about one person's bad experience with the FDIC, basically. So it does not cover what happened to the bank that caused it to get into that situation when he was running it, the president of that bank. And it really just deals with the time from when he said, I'm going to, when they said to the FDIC that they wanted to do a rescue plan that would have kept the bank open, and then to the point where all those things go wrong, all the miscommunications, all the politics, all the infighting, whatever, and then the bank fails, right? So most of it is just complaining about the FDIC's handling of this particular situation or everything. Maybe it would make a great magazine article or something of that time if it came out at the time that the Texas things were happening. And maybe, it'd be really interesting to people also when those personalities are involved and everything. But it gives like no information of the lead up to what caused it. There's very little information of, even about particularly the bank that he was running. And so it's interesting. I mean, some of the personalities I recognize and everything. So some of the people it goes to as investors, I recognize the names of and have read about them in other books and stuff. So it's interesting from that perspective. But it's definitely one that I'd say everyone else should skip. And you don't always know that reading about it ahead of time.
And Ski Inc. This is the book that you think I would like the best.
You would like it, yeah. I don't know if you'd like it the best, but I think you will like it. People who don't have any interest in skiing stuff at all, I don't know that they'll like it. Because it's not super heavy as a business thing. It's not someone talking about it who's an investor or something who knows a lot about businesses outside of skiing. So It's very focused on that particular thing. But yeah, I think that you will like it. Yeah.
Is owning a ski resort a great business?
Mixed. It's a lot. We've talked about this with the theme parks and things like that. So it's mixed. They require a certain amount of investment in them and improving them over time and all of that. And so there's certain strategies that you can have that are not such good strategies, and certain ways that you can run them that, but for the most part, does like theme parks and stuff, as long as they're getting some of the reinvestment they need and everything in them, does it really matter who owns them? Like they maintain their value as properties and stuff after that. Yeah. They're sort of, assets that once profitable do tend to still be successful later, no matter who's owning it. But even the things I talked about with the book about ABC and stuff, ABC and NBC and CBS have gone through different owners and everything, but it really hasn't mattered to them. You know, GE didn't work any magic on NBC to make it any better or any worse, and they sold it off to Comcast and changed it the other way. You know, so the economics of it and stuff mainly stay the same. So yeah, if it gets enough reinvestment in it and everything, yeah. And we talked about Six Flags, which went through disastrous times financially and everything, but we still talked about it as a stock that could be attractive. There's nothing wrong with the parks and stuff as long as they put enough money back into it. But there are some examples they give in there where, they really didn't put enough money into it or whatever. But it's not like a real data heavy book. But it's really short and stuff, but it is a completely business focus. It's not like gossipy or anything about the behind the scenes of the ski resorts or anything. It is really about the business of running a ski resort. And you get a real understanding of that, about how many beds there are in the area for people to stay over, to building the base for the resort, what it takes in terms of the little ski village that you have of retail and stuff, and how much that brings in for them, how much condo sales are important, ski lifts to move people, how long it takes to move them, how all of that kind of stuff, pre-sales of season passes versus things that are all day things that people are doing, and so it gets into you figure out, oh, this is how they make their money and everything, and these are the difficult things I didn't think about too, of the logistics of it. Because ski resorts are, like I've said about, Disney's best skill, right? If you go to the Disney parks and stuff, the thing where they excel beyond any of the other theme park operators is moving people around. And ski resorts do have that aspect to them too, that it's a big part of moving people around. A bunch of people come at the same time and want to get up, and making them wait a bunch of time and not maximizing the time that they're actually spending money and all of that kind of things, is an issue. And they talk about sometimes in it where they have here's how long the wait was from them to doing this, here's how much actual skiing they're able to get into, whatever. So reasons why one is more attractive than another, and why you have to invest in these lifts and all that kind of stuff. So it's stuff you might not think necessarily about. So it gives you a good idea of someone actually running it. But it's kind of like if there was a theme park book that's about someone who runs the theme parks. It is not from an investor perspective and stuff like that, I'd say.
And which books do you prefer? At this point, it's just much more about operators, not from the actual perspective of being an investor.
Well, the one I prefer the most that way is Beating the Odds, because it's someone who's basically running the company. Now, he owned fairly little stock in the company, and so he was subject to different raiders being able to try to take it over because it was a public company that whole time. But basically, someone who's the CEO for that time is the one I would like the most. But I say that, and yet I haven't read Hot Seat by Geoff Gannon, so which may be why I'm somewhat unfair to him in my assessment of that thing, of that period. But that's the one I haven't read of the GE books.
Wait, and that's actually written by Geoff
Immelt, Hot Seat, yeah.
I wonder how honest of an account that'll be.
I believe more people. Where is it? Yeah. So I think
that's pretty long. Yeah, 352 pages. Got a lot of reviews.
So I believe a lot more people have probably read that at this point than Power Failure.
I love it. 1 star. Blinded by his own ego.
Yeah.
Interesting.
And yeah, so it's hard to go on the reviews for books, because these sorts of things, like I said, they could be somewhat controversial or whatever. So you have to read why they're complaining about it or whatever, if it's their views about it. And that backs up the things that would be your concern reading it is oh, I'm going to get, the insider ones are tough because they are usually written as some sort of apology for them that way. And sometimes you read it and it's they just didn't like this person, so you get a lot of that.
Yeah.
I've never read the one that Eisner wrote, which was actually at his time at Disney, at that time. I know that I've not read that one, but I know that it was very not revealing, because he wasn't done with, yeah. So you really can't have that usually where someone writes a very honest appraisal, really candid appraisal of their time there when they're still there or something, or still connected to it,
Yeah, that's the hard part too, right? You think about Buffett, and he basically casted or asked Alice Schroeder to write his book, and he basically said whenever you come across something that's less flattering than I remember, choose the less flattering one, right? I feel it'd be very hard to, and just knowing from these other books that you've read about the CEO, Geoff Immelt, I feel it'd be kind of tough to take everything without a grain of salt. But I mean, maybe that's not fair on my part, right? I don't know.
But it also can be true for all the other books too, the guy who wrote Power Failure, mentions, that he was I don't know if he was the roommate, but he certainly knew the person who took over at GE after Immelt and then was replaced fairly quickly by, who was it, Larry Culp from Danaher. And is that right? Yeah, I think that's what I'm saying is right. So, he talks about him, and obviously maybe had more of a axe to grind that way or whatever, more familiarity that way with him. And so that may have caused him to be more biased against Immelt and be more biased about the CEO of GE who took over after him. Both,
Mm-hmm.
Sometimes that's why people, write these things. And they also just have biases in lots of other different ways. I'd say the way that GE Capital was written about here was a bit different than it was in Lights Out, and I attributed that to the greater financial background of the author in this one. So the way that he handled that and talked about it.
I'm currently reading the book Power Play, which is about Elon Musk, and it's Tesla and Elon Musk and the bet of the century. And it's so interesting reading books that they go through like different periods of, the company or whatever. And I'm at the point of like 2016, 2017, when Elon was, tweeting certain things, or he talked about buying the company for $420 per share. And then, after that whole thing happened, then, he needed and the what was it, the Thailand like children that got stuck in the cave, and he called the cave guy whatever he called them, and he needed like some sort of good PR, so he goes on Joe Rogan, but then he smokes weed on Joe Rogan. It's interesting hearing almost like an inside account from their perspective, because obviously I just remember that time as an outsider, basically just listening and seeing all this information on Twitter and people talking about it and reading about it in the financial news. So I like reading books where I remember exactly, well, maybe not exactly, but I generally remember like what I was doing, what I was thinking. I remember it playing out, and then hearing the other side of the story. I mean, who knows how accurate it is, right? Because it's not like Elon actually wrote it, and even if he did, maybe the truth would be somewhere in between. But I love books like that where I just remember where I was and what I was thinking, and just hearing the other side of it.
Yeah, and there's a reappraisal a lot of times over time. So it's interesting to read books that were written that they have a certain endpoint, so that they're not, up to today or whatever, too, because that also biases it a lot in terms of you're looking at what eventually happened versus other. I mean, the Jack Welch period, people would be a lot more favorable if it wasn't followed with Geoff Immelt. So, that they know that G is going to go down after that. I read a couple books. I mean, the eBay book I mentioned, that are written in the very, very early 2000s. And they often include a bit of a section where they say, why was eBay so successful and Amazon a failure? Because Amazon's stock had crashed by then. eBay held up incredibly well. eBay was making money. Amazon was losing money. Amazon's credit situation wasn't terrific. And eBay was this company that had more money than it needed and producing all this free cash flow, and like one of the companies that held up a lot better than anything else. And they both were seen as marketplaces for the internet that way. And the idea was the model of eBay succeeded, the model of Amazon failed. And then if it was, let's say 15 years on, or even almost 10 years on after that, people would talk about how if Amazon was so successful, why wasn't the other company that was from around that time that was a big success, why did it never go on to be like an Amazon, eBay, So they'd look at it the other way and say, well, how did that happen? I mean, eBay had all these advantages over it and didn't succeed to become as big as Amazon. Of course, eBay still succeeded in a tremendous way, but now that there were ones that came to become even much bigger, it's like, well, how did you not become a FANG type company? How did you not become one of the biggest companies in the world, Yeah.
It's funny though how like when you read something that was from the past, for example, like in Power Play, Elon really did not want to be public with Tesla because he didn't like the fact of, having to do the whole guidance thing and talk to analysts, and basically the fact that, they may not like something and can completely like, punish your stock, or perhaps you, in his point of view, we're investing for the future, but then at some point, Wall Street wants you to turn a profit, and, him faking, or whatever you want to call it, the 420 buyout or whatever, right? There was some truth in there, and there was a lot of truth in there, that he really wanted to be private, and then, figured out that that wasn't going to happen. But, fast forward to today, I mean, the reason he's the richest person in the world, and one can argue perhaps even the CEO of Twitter now, is because of the fact that they're public, and we just went through like a huge, speculative mania and the whole reflexivity thing. And they've been able to take advantage of being public and use their stock as currency. And now he's the owner of Twitter because, I mean, throw like a Ford or a different car manufacturer multiple on Tesla, or maybe what it would be valued in the private markets. Maybe he wouldn't be the richest person in the world, So it's just interesting how those things kind of can shift over time. And just reading about the past, what his thoughts were, assuming this is true, which I think is probably true. He didn't want to be public. But that actually turned out to be one of the reasons that, he's the richest person in the world currently, and he's really benefited from being public.
Yeah.
So because we are at the end of 2022, it's the point of reflection. Typically towards the end of the year, people think about things they did over the past year or over the year. What's your favorite book, since we're talking a lot about reading, right? What's your favorite book that you read in 2022?
My personal favorite was probably McElhenney's Gold, which is about the Tabasco company. So,
how do you spell that?
MC.
What is it?
I could get the book.
McElhenney. Never heard of it.
McIlhenny.
There we go. Tabasco.
Yeah.
Okay. Interesting. So I've
and
never
this is
heard of this
not
book.
a very favorable book towards the family.
Okay.
And is also not, I don't know how accurate it is in some ways. For instance, I believe it speculates on some things where I wouldn't be comfortable speculating that much, especially during the very early period around the Civil War, basically, and stuff. I think there's some truth to some of the things it says, but but the company's official history and stuff is not correct. But I think the kind of alternate history it gives for it might not be exactly correct either. I think we'll never know exactly what happened there, of like how they came up with the Tabasco sauce in the first place. But yeah, so it's basically a book about Tabasco sauce, about the company. So if you've seen Tabasco, what you think of just Tabasco. It is basically this one company that grew it into a few $100 million a year in sales. It claims, the book claims that they had a 20% profit margin when they had a few $100 million in sales already then, and it never, they didn't sell out at that point where the book ends and stuff. So, for a family business, obviously making a ton of money that way. However, they did not keep it close, in the sense that they allowed people to inherit equally over time. So this is the problem that you have with all these companies. I talked about this with John Wiley, which was able to stay family owned all those years, and people wonder, how's that possible? Like a lot of, royal lines or noble lines or whatever, the key is to have, a firstborn male heir, but not a lot of them. And so they had very few. So they had a direct line of very, very few children, basically, over time, as compared to lots of other companies would end up with. So, this ends up with like 100 family shareholders or something, because if you found something in right after the Civil War, fast forward 150 years, you're going to have descendants that you intended to be one person inheriting it that's now 100 and some, sort of like what happened with the Wall Street Journal, with the Bancroft family and all of that. So that's, common. You only see that with like the stocks wearing and stuff with NACO, over time. And that's a company that only existed for only about half the time that this company had,
Mm-hmm. No, it's so interesting. I love business books. I'm just looking through some of my books read from 2022. Let's see. Losing the Signal. Can't believe that, right? I feel like that was forever ago that we talked about that on the podcast. $1 Trillion Triage was interesting, right? An inside account of the Fed after Steve, I really liked, just because it was more so about like the operations of Apple with Tim Cook. And I honestly, I thought it was a great account of, we always talk about market power. And you've written about how companies don't steal profits from competitors. Companies steal profits from suppliers and customers. And that's a great example of Apple's market power and how they really squeeze their suppliers. So from like an operations perspective, I thought it was a very interesting book. Keeping at It was interesting. Let's see what else we got here. Bitter Brew. That was a great business book.
Right. I read Bitter Brew this year too. Yeah.
Do you have any thoughts on that?
Yeah, it was a good business book. It's a lot about a very dysfunctional family, though. A lot of it is
very dysfunctional. Yeah. Yeah. No, so I love books that are like that. But anyway, so we could go back to Focus Compounding. One thing that you did add in these blog posts, which people listening, you could click this Ask Geoff link right there, and you will be able to send him an email. He said, if you have any topics you'd like me to blog about, click the link below and let me know. So did you get any emails yet?
I've gotten some emails, and I have some ideas for blog posts anyway. And I actually have one written that didn't go up yet.
Okay, there you go. There you go. So go to focuscompounding.com to get access to those future blog posts, all for free. So we are kind of close to the end of the podcast, so we're not going to go too much into the topic. We will reserve that for next week. But we could just hit on, the current market, where we are, and some things that have happened that I guess one would consider material, just based on, the markets or whatever. S&P 500, we're down 60% year to date. All this pretty much is kind of still the same from last time that we recorded. The major news that came out was about inflation. Consumer prices rose last month at the slowest 12-month pace since December 2021. CPI climbed 7.1% in November from a year ago, which was down from 7.7% in October. Core CPI, which excludes energy and food, the volatileness of energy and food, rose 6% in November from a year ago, which is down from 6.3% in October. The CPI increased 0.1% in November from the prior month, compared with 0.4% in October. Core CPI rose 0.2% in November, down from rising 0.3% in October and 0.6% in August and September. So from that, inflation is starting to, I guess you could say, sort of level off, to come down a little bit, Geoff. I mean, the market took that as a very great sign, but it's crazy when you think about the fact that inflation is still growing. Call it 7%. Or inflation is still 7% over year. That's a pretty high inflation rate. And then today, it was the Fed Wednesday. The Fed came out and they raised the Fed funds by 0.50%, 50 basis points, and signaled a plan to keep raising rates in the next few meetings. Probably, I would imagine, another 50 basis points, but down from 4 consecutive increases of 75 bips. So the 50 basis point, basically they raised less. They still raised, but it was less than what it's been over the past 4 meetings. Current Fed funds benchmark rate range 4.25% to 4.50%. The one thing that I guess you could say surprised the market was the dot plot. Most officials plan to raise rates between 5% and 5.5%. next year, with the median projection implying a further 75 basis point rate hike. And in September, they anticipated only lifting it to around 4.6% by the end of next year. So higher rates for longer. And, that happened today. And it seems like, it's crazy to think that, rates have gone from nothing to, 4.25% to 4.5%. And they're going to get to 5 to 5.5. And it seems like the market really just isn't pricing any of that in further. It seems like the market thinks that the Fed is going to actually have to cut interest rates because that, we're going to price ourselves into a recession. And did you read Howard Marks's new memo, Geoff? Sea Change?
Yes, Sea Change, yeah.
So what I thought was interesting about that was he talks about, let's see, can you see my screen? Okay.
Yes.
He talks about he only remembers 2 real sea changes in his career. And he thinks that we're going through a third one today. And he talks about the Nifty 50 era when he started out in the business. And the first sea change was the evolution of the high yield junk bond market and sort of the widespread adoption of investing in securities or bonds that were not just like completely A rated or known as being safe investments. There was a level which you can invest in these quote unquote less risky investments as long as you were compensated for the risk you're taking. He says the US high yield bond market or bond universe amounted to about 2 billion when I first got involved, and today it stands at roughly 1.2 trillion. That was the first sea change. The second main sea change in his career was 40 years of declining interest rates from when Volcker took interest rates up to 20% to slow inflation. That left, a very long period of declining interest rates, which, all incentives behind that. It prompted investors to take more risk. Markets only went up. We created this SPAC boom or this bubble over the past couple of years that was really on the bedrock of liquidity. And then he talks about how, he thinks the third sea change is going to be really transitioning back to what he called a full return world, is what he called it, a full return world, where it's not just all about investing in stocks basically to earn any sort of return. Bonds, that were yielding 4 to 5% last year are yielding about 8%, which, could be close to equity-like returns. So I'm kind of curious to hear your thoughts on this sea change, if you agree with him, and, as individuals that don't just invest on autopilot and we are strategic and careful about the price that we're willing to pay. Do you agree with him? And do you think the future, if he's correct, will be better for value investors?
It might be relatively better for value investors than versus growth. I think, the period that we're talking about, really before his career starts, was a good one for, from the time his career starts, I should say, till rates started falling. Let's use that. So his career started in 1969, Howard Marks. And then rates are really falling in the beginning, at whatever, the 81 or 82 or something like that. So that period was the 70s, basically. And that's high inflation and weak and more unstable than anything, growth in the economy. You have several recessions in that period. That was good, very good for value investing versus growth investing. It was really bad for the Nifty 50. As he said, if you bought the Nifty 50 and held from 1969 till 1974, you lost 90% of your money. So that was obviously, that's the Peter Cundall period where all his, outperformance and everything happens really there in the 70s. It was a great time for a lot of the things we talked about with Warren Buffett. He buys the Washington Post early in the 70s. So that period is really strong for kind of who we think of as the best value investors, right? And it was not a good period for growth investing. The reverse has been true since shortly after the financial crisis. The first couple of years were okay for value investing, but basically the last 10 years until rates started rising, which was, only basically expectations for rates and all that really happened maybe 15 months ago, let's say. It was about the last 3 months of last year till now is when there was really the change in terms of expectations about rates from people investing in stocks and stuff. Let's at least say that. So like the ARC type of tech stocks and things, that kind of stuff started to really fall apart in the near the end of last year is when they were showing large losses and stuff, and value probably started outperforming at some point, last year. Since then, I guess it's dependent on how much weighted you are to like energy and financials and things like that. Some value things are a lot more weighted to that than growth. And some of those have done better. Energy has certainly, and financials last year did okay. So it's sort of, yeah. I mean, it's possible that we've seen that. I mean, certainly in rates, you've seen a complete change. Yeah. But the market doesn't necessarily expect that. And I think he talks a little about that. If you look at the market's kind of expecting rates to come back down fairly quickly. So, I mean, I think I share Howard Marks's biases, or are even more biased. And so that's why I have to be kind of careful here. Certainly, I'm more biased in wanting to see attractive investment opportunities. And we tend to invest in the, kinds of, to invest along the sort of same kinds of principles as like what he's talking about with Oaktree. We invest in different things, but we do prefer to invest in things where whether you want to call it, you don't have
like
to
ALICO. Perfect example, right?
You have a margin of safety, and you don't have to make particularly aggressive assumptions. You can make assumptions that are in the, you pay attention to that half of the distribution of possible future outcomes has to still be in things that, I have a way of making money in this, right? It can't all be the best case scenario is the one that makes me money, right? So we tend to be more conservative in our estimates of what the future will be, tend to be more conservative estimates of what the multiple expansion and stuff will be, right? So like when I have bought stocks, if you look at kind of what I've estimated the return in stocks should be that I bought over time, what I'd expect to make versus what I have made, there's a significant gap. I don't know, let's say 7 or more percentage, at least over 7% a year, that is explained only by multiples expanding in what I own more than I expected, right? So actual realized returns end up being a lot higher. And he's talked about why that is that you've had falling rates for that whole time. And that's been my entire career, my entire life in investing, not even just as a job, but starting when I did as a teenager till now is basically falling rates. Because it's all during the period he's talking about of the overall fall in rates. And then in terms of things like Fed funds and stuff, really, it was only the first 8 years or so that I was investing that was anywhere near normal. After that, it's been, pretty much low.
It seems like the whole market, like you talked about, thinks that we're going to get back to like 2020, 2021 markets, right? The Fed's going to cut interest rates, and then it's kind of back to risk on, right? And he kind of lays out a case how he thinks it's a new regime going forward. I love this table that he laid out, like Fed behavior in 2009 and 2021, highly stimulative. Today it's tightening, inflation dormant, versus today a 40-year high, economic outlook positive, versus today a recession likely. And he lays out a bunch of different things and how he just thinks going forward, maybe the Fed isn't going to cut interest rates back down to like nothing, right? Like he really believes that. And, there's going to be ample opportunities both in credit and in stocks. But if credit is yielding, 5, 6, 7, 8%, stocks basically need to adjust for that as well.
Yeah. And his estimate is actually quite low. So he says there are reasons why I believe that the base interest rate over the next several years is more likely to average 2 to 4%, not far from where it is now, than 0 to 2%. That's actually really conservative compared to the past history in the United States. So if we look at since the time the Fed stopped in being involved in yield curve control as sort of the date that we use till today, the first 20 years or so of that period is there on a certain Bretton Woods thing. So it's a little different than now, but basically they're an independent central bank from that point on. So if we look at that, that's like 70 years or so of data. The median Fed funds rate is basically where we are now. So it's about 4.1, 4.2%, something in that period. Means higher, obviously, because you have a few years in the late 70s or 80s that get to a ridiculous level. So it pulls up the arithmetic mean to over 4.5%. But what that tells you normally when you're looking at a series like that is that you would expect 4.5%. In addition to that, when Quan and I were looking at doing the reports on like Frost and the different banks for senior diligence, so, several years ago now, the other thing is that throughout the period overall, if we take that entire period, the Fed missed its mark on inflation, that the Fed funds rate was too low to hit the goals that they had more inflation than they wanted. That's even more true than you might think, because the 2% goal is a recent goal. We can argue about what their goals were at different times, but certainly in the beginning of that period, if we go back to the 50s, the goal was they weren't even saying we need to get 2% all the time. Their goal was really to, they didn't want a recession, a depression, but otherwise the goal was to have, stable prices. That was certainly what they were saying and what they were thinking. You can tell that from some of the things that they said that you can find in books now of that period. Now, by the 70s and stuff, maybe they were saying, well, we'll never get down to anything like that. It's just a matter of getting someone under control. So maybe the goals were much higher. If you think about a target, it would be much higher than today's 2%. But certainly they've missed since they've done 2%. I mean, we can see cumulatively from when the Fed says 2% to now, we are now cumulatively over that. They've overshot cumulatively over that whole period. On trend is now over 2%. And that's if inflation dropped to 2% tomorrow. You would still have ended up going over what you wanted. And they thought they were under for all of that, for virtually that whole period. And they were. But the overshoot that they've had of that has more than made up for that. So that would mean that you'd expect even higher rates. So like, for instance, if you look at the history in the past, like when I was talking about looking at it and just what was the Fed funds rate, what did inflation end up being, whatever. If the United States and the global economy and everything, the financial system as it is today, it was, let's say, similar to what it's been on average over the last 70 years or whatever, more than half the time, or half the time or more, let's say, at least half the time or more, the Fed funds rate would need to be at least about 5% or more to hit your goal. Because it was at least half the time over 4%, and you missed pretty significantly over that time. You'd say you'd missed by at least 1%. So like in real terms, it certainly seems that way, that the correct Fed funds rate on average, as a median number for the last 70, 75 years or so, would have been somewhere around 5%. That would have been the correct rate if we're saying, if we're defining neutral as we were trying to get 2% inflation. And that's not how the Fed defines neutral now, and the world's a different place. Population growth is a lot lower, for instance. There are demographic things that we know will not reverse. Other things we don't know if they'll reverse or not, right? We don't know if there's lots of other things that could change. The world could become more globalized, less globalized, this or that. We do know the population stuff won't change. Because that's something that's pretty easy to predict decades in the future. So there are totally differences between now and then. But the rates that we've had recently don't seem to be something that you should have, and be able to achieve the inflation goals that they had. But on the other hand, it has worked for Japan. In the sense that they have had very low rates and haven't had inflation for a very long time. So it is possible, but it is possible to have rates that are almost at zero and to have the inflation that we're talking about. So I can't rule out the possibility that it is, possible, right? That the rates that we've seen recently could be normal rates.
Does that change anything from your perspective as you're looking at companies?
Yeah, no, it does change things. I mean, since last year when we talked about this and we said, well, I think probably the rates will maybe have to be higher than what the Fed thinks or says or whatever, but they can keep pushing to just always be surprising a little bit more in their language that, no, it's going to be a bit higher than you think. No. And so every time they do that all year long, they could get to a rate that's higher than what people were predicting. So maybe, I forget what it was at the end of last year, people were predicting they'll get near 3% or something. I mean, it would have been down there somewhere. And they actually got to 4 to 4.5%. They actually exceeded it by, it's probably 1.5 times or more what they said what people were expecting that they would do. I don't remember what the exact estimates were, but it was probably something like that. So, in looking at stocks, and bank things is the most important for us that way. But in looking at stocks stuff throughout the year, I've always penciled in 6% as where we, so January 1st of 2022, I was putting in 6% as where we, as an estimate that anything that we invest in, that we make decisions about, whatever, certainly needs to look okay if it goes from 0 to 6 during basically 2022. It did not go from 0 to 6 in 2022. It's only at 4.25 to 4.5. And the expectations, I think, from the dot plot thing is low fives. You said they basically fall in the 5 to 5.5% range. So you're still below that number. And the market expectation is even lower than that. The trajectory is actually for it to be pretty early in 2023 to start coming down, right? I believe that's the market. So we'll see. About the inflation thing, I should say, this month's inflation report and the prior one, I think were unremarkable. To me, looking into the guts of what happened, core goods prices fell a lot. Okay. I believe sticky price inflation, sticky CPI was exactly the same over that period. So I think 5.5%. Which is, lower, and it's always been lower. The sticky price inflation sticky CPI has always been lower than in this period that we're talking about. It's been lower, and it's not in any way a leading indicator. So when I talk about that, I look at that and stuff. It's not because it's going to help you see the turn in inflation. This may be really good at showing a turn in inflation, that goods prices dropped a lot. However, service prices didn't. Labor market didn't. And if you're asking long-term what the correct interest rate is, I think it has to do with your labor market and with your services stuff. It's like when we talk about the Big Mac index, like why do you use a Big Mac? You use a Big Mac because it's a locally constructed product that you can compare from place to place, because it's pretty much the same thing, although a bit different. And it's not bought on credit. It's a high frequency purchase. It's a low price purchase, that sort of thing. It is, if you had to pick one thing, that would be a good thing to pick. What you don't pick is washing machines or big screen TVs or computers or autos or, any of that kind of stuff. Howard Marks talked about that in his, the memo we talked about, sea change, but also in others, that durable goods prices are a big part. I think he estimated, 0.5% a year, 0.5, 0.6% a year over the period he looked at, which is the last 25 years, the decline in that. And the other thing about that is those are generally imports. So that's the other part about the shift from it, is that the rate of, let's just say this, I would expect the inflation, we have no idea what will happen, because I always say this, that part of it is to be right about these things longer term. You have to not just predict what will happen based on current trends, but then you have to say the actual outcome is based on how others respond to that. So, right, if you saw COVID happening and you thought, oh, well, things won't really all get locked down, and the Fed will relax things, but not incredibly, and there'll be some aid for things and whatever, but not some huge spending package. Those would have been reasonable estimates for you to have. So you never would have expected as sharp a decline or as huge a rebound or a lot of inflation. So you could have expected slight deflationary pressures or something from that. Or you could have expected, well, there'll be a bit of transitory inflation because of supply things or whatever. But you would have had to predict government response and central bank response and all that. Same thing here. But I would expect in the future that inflation in the United States could be quite a bit higher than in places like China and in places where we import a lot of the things that we're talking about from. There are very different pressures in some of those other economies. There's a bunch of economies that have, unlike the United States, have greatly increased the amount of debt that they have for business things and invested a lot in factories and in apartments and housing and whatever things, a lot of other things, but a lot of long-term fixed assets financed by a lot of debt growth. There hasn't been a lot of, since the financial crisis, it's not like the United States private sector has gone on borrowing a lot of money and spending a lot in these long-term asset things. Obviously, the last few years we've had large deficits, government deficits, but otherwise we're not talking about some debt-fueled investment binge, whereas China's been on a decade-long, historically unprecedented growth in debt and high investment in sort of things that are pretty far away from the consumer, which is similar to what happened in Japan and stuff. So you could certainly see a lot of deflationary pressures in some other places, and if you import things from them, then maybe that will contribute to it, right? But the other thing is that I always feel when we talk about this is predicting future inflation. The problem with predicting future inflation, like people say, oh, well, population will have this effect, which will cause this effect on inflation, or, I think the internet will cause is a deflationary pressure in this point or whatever. Okay, but the issue is that you have a central bank which basically has a target. So in a sense, what you, for the most part, except for some extreme things like the zero bound that they can't really do all that much about, they can do some special stuff to try to get somewhat below that, but there's not much they can do about that. Other than that kind of thing, they are largely responsible for inflation in the sense that it is theoretically possible that they can set a rate to get the inflation rate, they set Fed funds rates to get the inflation rate they want. Now, that doesn't mean they're responsible like they're causing inflation, and it doesn't mean that running large fiscal deficits or anything like that has nothing to do with it, that it doesn't matter. What it means is that in theory, they have the tools, they have the capability that they could offset anything done in that is a shock one way or the other, or is a force one way or the other. So, if you didn't have deficits, then obviously you wouldn't require the same Fed funds rate to achieve the same inflation over time. But if you do have deficits, then you can just change the rate to offset that fact. If you do have a shock from whatever energy things, whatever, then you could always do it one way or the other, or what we talked about with COVID. In theory, if they really can set the rate at wherever they want and they're willing to do it, they don't cave into any sort of pressures or whatever, then the rate of inflation that you'll get over time should be the rate that they're able to stomach, right? So like, in theory, in the very long term, what will the inflation rate be? The simplest answer that you would think is, what can the Fed live with? What are they willing to do? And what kind of inflation can they live with? And that should be the right answer for the most part, except for like when we talk about the zero bound or something like that. So whatever happens in other ways, how far will they go to offset that? The issue now, of course, is that people are expecting a recession. And so they're expecting a cut in rates quickly to deal with that. The longer term thing for investing in general and just worrying about it overall is that what does it look like after that? We've talked about that. I don't know that I do think that it did not matter how quickly they get to some rate. First of all, you can communicate where you're going. And if people really believe that you were going to be at 6, like say if the market was completely convinced you're going to be at 6 to 7% sometime in 2023, I don't think they care if you did that with some front-loaded high rate hikes or slower over time. It would, if you really could communicate that in an incredible way, it would trickle through to things pretty, this year in a way that's not that different from what we've seen, how you spread out the rate hikes. But I think that the issue is what does the market really believe about what will happen when there's a recession, how far you'll cut it and how long you'll keep it down. The market obviously expects, and it's not just the market, it's a bunch of people at strategists and things like that, investment banks and all of those, expect a pretty big decline in inflation regardless of what the Fed funds rate is at. So it's not just that the expectation is not just that the Fed funds rate will be lower and inflation quite a bit higher, but actually that inflation will still come down, even though the Fed funds rate will come down a bunch in a recession. So we'll see. I think the thing that I've always said is like the bigger, longer term thing is really, what does it look like at the bottom of a recession? Where are you with the Fed funds rate and how quickly are you willing to go back up? So basically, what does inflation look like there? It is interesting to wonder, like, is 2% the bottom? It's now a minimum for a while. Because if they really mean 2% average, that's hard to believe that that's going to happen. That isn't the expectation. So basically, markets have an expectation that, say, inflation will be 2 to 3%, more like 3%, and the Fed will be aggressively cutting. So it would require cutting rates even when inflation is well above your target. So, we'll see if that happens. But what if it's 3% you cut and it starts to go back up from 3 or 2? What if it never hits 2%, but it gets close, but it's rising after that? What do you do? So we'll see. Normally, if you have a recession, obviously unemployment increases by more than 2%. 2-3% is not uncommon at all. So if we're at 3.5%, we're through a 3.7 or something, then you'd expect that we'd be close to 6, right? So that's the kind of environment to think in terms of like, what would they do? Well, they'd now be making the decision with, say, 6% unemployment, right? That's kind of the question to ask, is that possible? Now, what they say, of course, is that it doesn't have to go that high because we could just get the number of jobs, opportunities, jobs, unfilled jobs versus job seekers down to like 1 instead of 1.5 or whatever it's at now, that we could bring it down, and that it doesn't really have to cause unemployment. But normally once you set these things in motion, the Fed's never caused a small degree of unemployment without causing a large one, and they know that. So, once unemployment ticks up by more than a little bit, it's almost always increased by several percent, or by a few percent, I should say.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. If this is the first time you're tuning in, go to focuscompounding.com to get access to everything that we put out into the investing world, blog posts. We run capital, we manage capital. You can get information on that by clicking that Invest With Us tab. And then we have our podcast backlog there as well. Wherever you are listening or watching to us, make sure you hit the subscribe button. Give us a rating review. That still goes a very long way for us. And we will see you in the next podcast. Thank you so much for tuning in. Take care.